So welcome back. I'm Niall Walker. I'm an insurance agent with almost 40 years of experience. I am a certified insurance counselor and has owned my own agency for the last 20 years, and prior to that I worked as a direct agent for a commercial carrier. I just wanted to visit with you a little bit today about some things concerning auto insurance, and the one topic I thought I'd approach this morning was why does my auto insurance keep going up? First, I must explain how insurance companies determine their rates before you can understand why the rates are being adversely affected today. Insurance companies understand that if you can get a large group of individuals together to pay a premium for the few losses that occur, the rates can be stable and predictable. This is even more possible the larger the group is and how more defined it would be. So let me give you an example. So let's suppose these beans represent 30-year-old male drivers of an auto insurance policy. So there they all are. Oop. And they're hard to hold on to, but anyway, here they are. So you have all these 30-year-old drivers. And one insurance company takes them and they insure them, and they can predict the rates for their drivers are going to be, let's say, $400 every year. And another insurance company comes along and they determine that if they separate from the average 30-year-old drivers, those 30-year-old drivers that are, let's say, have a great credit score, so their credit scores are high, and they only insure those, and those represent by the pinto beans, and they begin to insure more and more of those because that risk has lower claims, and so therefore instead of charging $400 are able to charge $360. And not only do they continue to add to their pool those people that fit that model, but they also start taking some of those same people away from the competitor who has drivers that do not have that high credit score, whose loss experience is higher, whose premium would be about $440 a year, which would be represented by this jar with only those drivers that are single males without a high credit score. And so this particular pool here of insureds rate is the best because their pool has the lowest exposure. The other one that was in place for a while, who rules were not as strict, has a little higher rate, and the one that has the highest rate is the one that's all drivers with low credit scores. So if you happen to be in this pool here, the original pool, who has been losing their best drivers out of that pool, then your rates will begin to climb. So that's one of the things that can affect your insurance premiums, in that these pools are constantly shifting because carriers come out with a different set of rules. They have what they call actuaries that do lots of calculations, and they can predict the possibility of claims and all that, and that information is gathered, and as a result of that information, these insurance companies will begin different pools, start stealing clients from each other, and that makes the rates change for those carriers that may have an older group of people that are not as defined. Oh, and to understand what they use for that, and this is important for you to understand because your rates are determined by a lot of these factors, and probably even more than I've got listed here. So let me just share with you some of those things. They are using the age of drivers. They're using your financial strength. They're using your driving history, like citations and accidents. They also have determined that how long you are constantly or continually insured will affect, or they can predict, your claim. So somebody that's been insured for 10 years constantly, or somebody that just took out insurance 3 months ago, there's a difference in the claims that are processed and handled and occur for that group of people that are buying insurance on a regular basis and allowing their policies to lapse. Education or profession. There is a lot of insurance companies that have credits available to those with degrees. Again, because somebody that may have a high degree of education may be more stable, more cautious, and so on and so forth, in certain industries over others. So again, that's another thing they use. They also use multiple policies or multiple risks. So if you are insuring a single vehicle, your rates will be much higher than the same person with everything else that's identical to you who's insuring 2 or 3 vehicles. And the reason for that is they understand that the one driver can't drive 3 vehicles at one time. Now their overall rate will be higher for all 3 vehicles, but the rate per vehicle will be considerably less. So that's another factor. They also take a look at losses. You'll see lots of advertising about how their rates went up as a result of a loss. But losses are also a predictor of future losses. So that is another factor they're used. The usage of your vehicle and the miles that you commute, so how far you're driving in it each day. Obviously and I'm in the state of Washington, we have a lot of people that live north of Seattle or south of Seattle, maybe as far as 30 or 40 miles away. They commute each day on the freeway. Somebody like that's spending an hour and a half on the roads every day trying to get to and from work are much more likely to have incidents than somebody living in and working in their own little neighborhood. And also the age of the drivers. And certainly the one group of drivers that are heavily impacted are youthful drivers. So for those of you that are parents and you have teenage drivers, be aware that it's going to be a very costly investment to have your children driving on the road. And I can assure you that it's certainly earned. I remember as a young man, now this has been a few years ago, my memory isn't as good as it used to be, but I do remember when I was in high school and I was taking driver's ed. I was raised on a farm, so I started driving tractors and stuff probably when I was about 10, 12 years old. So by the time I got to school and took driver's ed, I was very familiar with steering and braking and all that kind of stuff, even a manual transmission. So as I went into driver's ed, the teacher mentioned how good a driver I was, and anyway, so it went really well. But towards the very end of the class, he says, "Niall, you're a very good driver. You'll have an accident within 12 months." I think he meant that because I was confident and thought I was really good, that I'd probably be more of an aggressive driver than others, and he was absolutely right. I was driving from between a little town in Idaho to a little larger community called Pocatello, and had been spending the day at a natural hot spring swimming pool, and I had the opportunity to roll a car over in the middle of a freeway. I think it was I-80, but anyway. So the young drivers don't have experience, and so there is a reason their rates are higher. So another factor that will increase and change your rates and why your rates will continue to go up is there's outside trends. So not just the driver or the vehicle you're operating, your experience and your likelihood of having accidents. That's not the only reason that rates are increasing. The other reason the rates may increase is because of what we're seeing outside of your ability to change. So for instance, the congestion on I-5 in western Washington or in the Seattle area becomes more and more congested. And as a result of that, the incidents per thousand of accidents are increasing. So even though everything else has remained the same, if there's more accidents that are occurring and the claims are coming in as a result of those accidents, then everybody's premium has to be increased in order to compensate for those increased claims. Another factor that's having a huge impact is the value of vehicles or the cost to repair vehicles. So it wasn't that long ago that you'd buy a $20,000 vehicle and it was a pretty nice vehicle, and now we're spending $45,000, even $65,000 to $70,000 for a vehicle. Obviously, when those vehicles are damaged in an accident or destroyed, the claims are considerably higher than they used to be as a result of the value of the car. We also are finding that all these special features they have on vehicles, such as your backup cameras, your sensors for the parking too close, and all these other kinds of things, those sensors and all that electronic equipment is now in the body of the vehicle. So a small fender bender, damage to the side quarter panel or whatever it might be, used to be just a few $100s to repair the skin, but now you're having to replace and repair all kinds of electronics. So commonly $1,000 damage to a vehicle a few years ago is now costing $5,000, maybe even $7,000 to repair, depending upon the extent and the expense of that electronic equipment. And then, of course, there's one other factor that affects your rates and always will, and that is the we call it inflation, but basically it means the devaluation of our currency. So every year your money is able to buy less. It becomes worth less. And so even though everything would stay exactly the same, simply because our money becomes worth less each year, then obviously there's going to have to be some changes in the rates to compensate for that devaluation of our currency. Some of these things we can reverse or control. So I hope you take a look at your driving habits, take a look at whether or not the insurance company has all the information that they need in order to rate you properly. Obviously keep your driving careful and avoid being distracted and all those kind of things. That can have an impact. You also can shop for your insurance, because as I mentioned, a pool that is deteriorating because the best drivers are leaving that pool, if you're part of that pool, it might be wise to take a look and see if there's another insurance company that has a better rate for your particular age. Just be aware that that's a constant battle, because every insurance company's rates will fluctuate because of that, how that all works. And so my recommendation, if you want to take a look at an insurance rate, I would certainly shop when you see a significant change in your premium. If your premium just slightly changing each year, I don't know if I'd go to the work of doing lots of shopping and comparisons, because probably those factors that are affecting all insurance companies is why your rates are slightly going up. But if you have a significant change, that would indicate to me that there's something that's occurred that's moved you from a competitive rate and moved you into another pool of people who have higher losses. Anyway, I hope that was some help. For those of you that would like to get a little more information about insurance, maybe have some other questions about either your home or your auto or even your business, I do have other videos, and please, if you'd like additional information, go to my website, which is walkerinsuranceagency.net, and I have those videos that are posted there on that website as well. And I appreciate you taking a look at the video today and getting some answers about why your insurance premium may be increasing. Thank you.